Hi, Mark Anderson here, Paramount Bank. I'm here with this week's weekly rate talk. The concept that I wanted to talk about this week is actually more important than rate movement. Rates this week are marginally, very marginally lower than they were last week. But what I wanted to talk about today was a really important concept that you should know as a consumer if you're looking into your mortgage options. And it's a little bit of a primer on how these rates actually work behind the scenes and how they're tied to the fees that you're charged at the closing table. So one of the most common questions that I get is, somebody will call in and say, well, what's your rate today on a 30-year fixed? It would be really nice if it was that easy that there was just a 30-year fixed rate and everybody that was applying for it got the same rate. But unfortunately, or fortunately, depending on how you look at it, these rates are based on a lot of different criteria. If you've got a really good credit score, you're going to qualify for a better rate than if you don't in general. But it goes a little bit deeper than that. What I've got here, and these are just made up interest rates. They're actually way higher than what the rates are doing in the market right now. I wanted to just share this to illustrate the concept. So let's say that the prevailing rate environment looks something like this. Now you'll notice that the rates that I have here are associated with numbers in either red or in blue. And that has to do with the profits or the revenue generated based on that interest rate. So when you call a lender and you ask what is the rate, the picture that they're going to see when they price your scenario actually looks a lot like this. So on this given day, in this example, what we've got are different rates from 6% all the way up to 6.375, and they are associated with different levels of fees. Now, for any loan application you're going to make with any lender, you should ask them what their base lender fee is. What's their standard charge that they charge on any transaction? That's going to vary a little bit between lender to lender. Next up, there is either going to be a credit, a lender credit, or a discount fee associated with each available interest rate. It's actually somewhat rare that a rate will be at a zero over here. There's usually somewhat of a credit or somewhat or maybe more than somewhat of an actual discount fee associated with it. And what we have up here is a rate of 6%. You can get that rate if you're willing to pay 0.912% of the loan amount, which in this case would come out to $18.24. As the rate goes higher, the revenue associated with that loan goes higher along with it. So the amount that you pay in discount is comparably less. So in this case, you see 6 1/8 is a 0.366% discount fee, which comes out to $7.34. Now the rate that you would probably get from this lender, if this is the way that rates were stacked up, they would probably target this rate because it's the rate at which there is no discount fee required. But you can actually see here, there's a little bit of a lender credit. One thing a smart consumer can do when you're going to lock in your interest rate is just ask, is there a credit of any amount associated with that interest rate? The majority of the time, there's either going to be a fee or a credit available with that particular interest rate. Now, the last thing I'll mention here, as the rates go up to 6.375, you see that the lender credit associated goes up as well. This is the way lenders achieve offering the no-cost refinance. There's no tricks to it. A lot of times lenders make it sound simpler than it really is, but this is really what's going on. You're taking a higher than standard rate to get the lender credit that allows the lender to cover those costs. So I just thought this would be a good quick primer for anybody that's out there looking at rates to inform that process for you. Thank you very much.